Hi, everybody. Same to you, Kevin. Hope you have a good week. Everyone hearing my voice, our voices today, that you have a great week. Hugo, how are you? Shahab, Alexander. Let's be disciplined and let's be patient. And remember, we have the Fed, right? So we have the Fed. Start talking about the Fed right now. I'm short euro from last night. You have my screen now? Okay. No? TJ? Everyone else had? Oh, resume share. Okay, here you go. You have it, Arena? How about now? There you go. Okay, so Euro's coming off, right? So expecting a bounce. Remember, only hold what you really feel comfortable with in the central bank. I'm thinking back to last month, and last month, I listened to Blake's week ahead video too, and I'm on the same page. Last month, um, there was a rally during the presser. Everything popped on risk, and it was a great fade. It was one of the best days I had in a long time. And I'm thinking, could it be, that path that all I have to do is wait for the Fed presser again this Wednesday to fade things? I mean, I'll do it if that happens, but Blake was talking about on the week ahead video, and if you don't watch it every Sunday, it does give you excellent preparation and some real good ideas for the week ahead. So that should be on your, your weekly trade planning is to get Blake's take on what's happening. And he made the point that, everyone's expecting, dovish remarks, continued dovish remarks by Powell. But that's kind of pat, and maybe the surprise is going to be that he's not quite as dovish as he used to be. I mean, he has a lot of cushion with the market up here at 4,200 ish. So a sell off wouldn't be the worst thing. And who knows? Maybe the Fed wants to tamp down on some of the rampant speculation in many groups, many different asset classes. And so we'll see. Maybe the smart play is to come in and be short prior. So what happened Friday, I think was important in the S&Ps, that we made a new high here going into the close. All right. And we didn't confirm. NASDAQ did not make a new high. See that? And the important thing to me was on the reason I was looking for a new high was before we got it. You guys see this RSI reading? Okay, at the high right here, it was a confirmed, it was a confirmed high. And then we just moved sideways most of the week and then popped on Friday to make a new high, marginal new high. And look at the RSI on the daily here now. Okay, so it did what it had to do. Are we going to push to 4220? Could be. I've heard targets as high as 4314 and even 4400. I don't think we're going to see 4400. And even if, right up here in the 42 to 4220 level, there should at least be a trade. If it's not the top, it could be good for at least a trade because you go across most of the time frames. We didn't confirm on the 4-hour. We didn't confirm on the 2-hour. And the only trigger that's missing is the 15-minute. Okay. So this will be my trigger. And you could see we have new highs. There's a little divergence, but the reading's 83. So we need a new high in the S&P with even the 15-minute. I'd like to see that. So that's going to be the trigger for me, is when we start diverging on the shortest time frame that I follow. Everyone with me on that? Okay, and I just want to show you guys the gold because I'm hoping it rallies one more time. But check out the trend line. It's on right here. Okay, so There might be a pretty good chance this week, especially if the dollar rebounds, for us to negate the breakout under 1760 and have a continuation move to new lows. Silver acting a little better. Crude still, I'm still bearish crude. Okay, caught it last week. If by any chance we get risk on and we get another move up towards near 63, that's my sell zone. Maybe we're going to hold a higher low and try and rally one more time. To me, that would be a great selling opportunity, whether it's before the Fed, on the Fed, or after the Fed. And let's see, anything else I want to talk about? Oh, yeah, that Bitcoin is rebounding. Dixie, where could the Dixie go? See, we had this divergence in Dixie here. So maybe we get back to 91.5, maybe 92 this time. Okay, so we'll see. We could just rally and go down one more time for a 3. But even Blake said it, probably because he was looking for a short in the euro, to be careful being short the dollar down here. So great week ahead video, Blake. And you think perversely, like I do, that anything that is obviously wrong. So
Well,
pretty obvious to just wait for the Fed and fade them like last month.
Well, so that, I mean, it's hard. It is really, really hard to assume that the Fed is going to be anything but dovish.
Right.
Right.
Yeah.
I mean, it just is. But that doesn't mean that they won't be dovish, just may not be as dovish as the market was hoping for. So I don't know.
Yeah.
I think that the safe play this week is, just
Stand aside.
And you just got to stand aside early
and react after during the presser, or
I think so. I think that's the play, because unless you can find a good entry point somewhere. I mean, if you let's say today would be a good example. Like, let's say today we get the dollar reaching lower somewhere against here. Let me grab the charts really quick.
Okay.
So let's say you're looking at a dollar pair well, let's just say the euro, for example. Now the euro overnight just reached for the resistance. This is what we were talking about on the week ahead video.
Good call.
Well, thanks. I mean,
so far.
Yeah, right.
Everything's so far, isn't it?
Yeah, great call for now, right? And
yeah,
we'll see what happens. But let's say let's just say you watch the week ahead video over this weekend, and you're like, okay, when the euro gets above 121, I'm going to short it.
Right.
And you did short it above 121 because that's what you were seeing on the week ahead video, and you kind of heard my commentary. Well, maybe at this point you're in a trade at, let's say you're short at, we went as high as 121.16. Let's say you got short at 121.10. And you got filled, then great, fantastic. Then you got your position on, and maybe you move your stops to break even, and then you continue on from there. Does that make sense?
Or maybe take 30 pips and start the week off, take a part of your position off, plus 30, and that reduces the risk on the trade.
Yeah. And then, if you can find certain areas to get in ahead of an event, let's say you have that feeling that you're just talking about, Dale, okay, I really feel that the market is, poorly positioned for the Fed this week. And, maybe your feeling is Powell's going to actually be a little bit more hawkish, and how can he be so dovish with all the economic data that's come out, blah, 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 blah. And that's your idea, right? Those are your ideas.
Yeah.
And you're like, okay, I want to position myself long the dollar ahead of, ahead of the event. Well, it's then about trying to find a good entry point between now and then, right? So, maybe the euro dollar, that was it. Or perhaps, you're looking at dollar Swiss and you're like, I really want to get long the dollar Swiss here. I'd like to buy it when it dips right back down to this, this is the previous inverted head and shoulder pattern target, right? So let me delete this one. So let's say you're like, okay, well, when or if it gets to 90.85, I want to get long because I do want to be long ahead of the FOMC. And then you just try to get your position on, there. And if you can, great. And if you can't, then just wait for the FOMC on Wednesday. I know no one wants to wait around,
Yeah. They should play Tom Petty's "Waiting is the Hardest Part."
Yeah, they should. Or maybe you should sing it for us.
I'd like to.
Yeah,
he's out of my range a little bit though.
So hey, let's talk a little bit about these cryptocurrencies. Sanse said Bitcoin's up almost 10%. It's interesting. Bitcoin over the weekend we sold off pretty good.
Yeah.
And let me pull up really.
And you said we would on Friday, Blake. Well done.
What? Say what?
You said we would sell off during the weekend.
I thought we would sell off during the weekend. I'm surprised that last night's bounce. Where the hell is my cryptocurrencies at? Oh, there they are. Okay. So, I thought we'd slide over the weekend because, and by the way, I still feel that we're, below this channel support. It's hard for me to be bullish. These bounces that you see here are just, in my opinion, are just, recoveries. But, we were kind of moving down over the weekend, then we sold off and hit a brief new low and then bounced, and now we're just bouncing back to the breakdown point. I sure as hell wouldn't want to be long right here, if you didn't pick it up down below 50K, I don't know why you'd be buying it right now, because this is the breakdown point of a triangle. So a lot of times you revisit those breakdown points and then you reverse again. Anyway, but I still think that Bitcoin is holding up pretty well, and so is Ethereum. I mean, look at Ethereum; we're right back at the highs. I mean, we had a false breakout on Friday. We slid, and then or Thursday or Friday, whatever day that was, and then now we're just kind of consolidating. But I don't know. I look at these cryptocurrencies, and I think they're vulnerable, and that's one of the things that. When you see that the vulnerabilities of some of these cryptos, like how many people were in Dogecoin, and I think there's a lot of people that were chasing Dogecoin and are long up in these neighborhoods, and now they're just kind of sitting in it going, well, I hope it turns higher. Everybody's kind of the holding on for dear life, the hodls. But I'm watching these cryptocurrencies because I do think that they are still a pretty good measure of risk taking in the market. If they really start to come off again, or if we start to see a little bit of a sell off, I think it's going to weigh on risk. I was passed over an email exchange from a gentleman that I know, and he was emailing with this fund manager who's also a contributor in Barron's, and he was looking for over this next year for Bitcoin to slide towards like 30,000 and really just spend most of the year just kind of holding down at those levels as it consolidates recent gains. And that makes a lot of sense to me, just because I think that there's so much institutional money now in cryptocurrencies that you're going to see it, whatever slide that we see in crypto, you're going to see it eventually stall. So, and then that downside will stall. I am keeping an eye on like the dollar Canadian this morning, and the Aussie dollar. Some of these commodity currencies, they are strong. I still think that the Aussie's trying to carve out the head and shoulder pattern. And I think these moves up towards 78 cents are selling opportunities.
I was going to ask you on this one, Blake. Could the Aussie strength, being one of the strongest pairs against the dollar today, be unwinding of the long Euro Aussie trade, and that's why there's some more strength in Aussie today?
I always think that there's cross rates do play into a lot of these currency moves. I don't know. I think the Euro Aussie has been sliding for quite some time, and so I don't know if it's really factored too much into that. I think a lot of the Aussie just
Buoyancy. Yeah.
buoyancy
Yeah.
is due predominantly to just the
Squeezing
stocks
some
being,
shorts before it fails. I
I mean,
posted a link, Blake, that Charlie wrote a pretty good piece. I put it in the chat about how the regulators are anti, Bitcoin and crypto, and how they're going to get in the way of, at least try and stall it, even though the, horse is already out of the barn. Their negativity towards crypto. So a good article from the New York Post by Charlie Gasparino. I just posted it there. And I forgot to mention to everyone, Peter Bookvar will be with us at the bottom of the hour. Haven't talked to Peter in a while, and a lot to catch up on. He's a CNBC contributor.
Yeah. For those of you that don't know who Peter Bookvar is, he's a lot of fun to listen to. Obviously, very intelligent guy. I've been watching that guy on CNBC financial news stations for years. It's really nice when Dale gets an opportunity to spend some time with people that you see on TV a lot of times, but you usually get just a few minute clips here and there. So Peter's going to be great to listen in today. So make sure you guys stick around for the interview. And by the way, if you guys are not watching via excuse me, if you're not watching via Zoom and you're watching via YouTube, please give us a thumbs up and let us know that you appreciate these webinars. We appreciate you doing that. Let me go back to what I was saying about the Aussie. So the Aussie and like the Kiwi and the Canadian, those currencies are strong. The dollar Canadian sliding below the 124.60, 124.70. I think a lot of that has to do with just equities. I mean, we are just poised. Look at the S&P. We're poised at the highs. And as I told you guys last week, the 41.10 level is support. I mean, this is a number on our bias chart we wrote down all week last week. This is the support level we've written down, and it held, and it's not giving way. And as long as this 41.10 level holds, you have to imagine that the dollar is going to stay weak, especially against some of these commodity currencies. The only way it's going to turn higher at this stage in the game is with some help with equities, and right now equities are just poised at their highs. So with that being said, I want to bring in Stelios and Steve. How you guys doing this morning? How was your weekend? What are you guys looking at right now?
Good morning.
Good morning.
Hello, everybody.
Morning,
Good
Hi,
morning.
Morning, Steve.
Yeah.
What's up, guys?
I'm good. Everything's good. I think, Blake, you said it. I mean, obviously over the weekend, the main mover once again was cryptos, and their bounce was very impressive, I must say. I had drawn a chart that I thought when they broke below 50, there was a zone around 42, 43, somewhere there, 43K. I thought it would have tested that, but clearly the people who like it got in early and are just taking it higher again. But apart from that, I mean, there's nothing, there's been nothing really in early Asian trading, and I guess we're waiting for the FOMC. And I think I agree with you. The dollar has to do something. Otherwise, these commodity currencies are just going to keep rallying, and maybe the market's going to be relatively quiet before the FOMC, but they might give us something. But for the moment, it's just a one-way train.
One thing that Steve, I want to hear your thoughts too. But one thing I forgot to mention before when I was talking about the markets is you got to look at yields. Yields are popping back up this morning on the 10-year, and they're pretty strong. Steph in our chat room, she was pointing out how strong the yields were this morning, and this push up in yields. What we're seeing that do is push up like the dollar yen and some of the other yen pairs. So you can see the dollar yen is starting to move higher, and you got to watch this because if the dollar yen starts to gain some strength, it could push up other yen pairs as well. And the dollar yen is coming right back to this 108.35, which was massive support. That should act as current resistance.
And it would be negative for gold, right, Blake?
I would think
the yen
so.
Keeps going.
I would think that we'd see gold and silver continue to slide. And silver's at its lows of the session right now, by the way.
Gold's breaking that trend line that I showed earlier at the opening.
Oh, okay. I wasn't looking at your screen at that moment.
But, the uptrend from the low at 1680-ish, and then there was a low at 1725, and then Friday's low, it's cracking it.
Oh, should be like right about.
Yeah, it's an obvious one. Yeah.
Yep, and that you're right, Dale. That is it's breaking that trend line, and that means we can come back and really retest this 1760, which is really key.
The breakout.
It's like the double bottom. And if you're listening to the webinars that we do after here, the Morning Edge, we talked about the pennant completion. We basically hit 1800, and we're like, yeah, that's done, because when you have a pennant or you have a flag and you have a completion level that you're looking for, a lot of times you don't ever reach it because everybody's looking for that same target price. So coming up against a round number, you got a lot of take profits ahead of target there. And so now you are at risk of pulling back a little bit. So good eye there, Dale. So Steve, good morning. How are you?
I'm good, mate. How have you been?
Good. It's Monday. I was going to complain it's Monday. No, good. Just watching equities continue to rally. We're sitting up at all-time highs here. How are you feeling about the markets? How are you feeling? What do you have your eyes on right now?
I'm very bullish. I'll start accumulating a portfolio of stocks here.
Your generational low was hit last night?
Yes.
Yeah, generational low, and you're going to look to go long for targeting
long
S&P
like Donkey
9,000?
Kong. Yes.
Okay. So aside from the sarcasm, what are you looking for right here?
Kidding aside, I remain bullish because I've seen nothing that points to a reversal. Oppositely, what I'm seeing here is another bullish consolidation. So yes, obviously, buying with zero pullbacks is a recipe for disaster at some point, and these are not the odds I want to be trading. But my bias remains bullish because I've seen bullish risk assets bearish the dollar.
Yeah,
undeniably.
So this is the chat room for ForexAnalytix. You can see there's a lot of us chatting this morning. And granted, I've only been up for about an hour or whatever. But I want to just point out, let's see, some comments, some charts. This is my comment from roughly 50 minutes ago. I said, feels like a pause in equities before we rip to new all-time highs.
Yeah, I totally agree. I totally agree.
That's exactly my sentiment an hour ago in the ForexAnalytix chat room.
I've been saying that for weeks, that people should not be eating the bait whenever we see a little bit of a negative day, because so far we've seen equity markets doing nothing wrong. The dollar downtrend doing nothing to alleviate the pressure for the dollar. Yes, we've had a couple of weeks of a rebound, but the nature of that rebound was looking nothing but corrective in my eyes, at least. So, until proven otherwise, the status quo remains.
Yeah, right. And we have now we have the Fed this week, and as you probably heard me say a little bit earlier, I'm expecting, just like everybody else, we're expecting a Fed chairman that's going to be dovish. I mean, why should we expect otherwise? He's been
Exactly.
but dovish.
Exactly.
But economic data has been improving, and that's. I know it's we sit here and say, well, that can't be ignored, but he has been ignoring it. You know, I think the market has continues to ask, will the Fed chairman continue to dismiss the good data that we've seen?
Of course you will.
Okay, so why?
Because to begin with, it's artificial. First of all, any data that comes out now is in comparison to a year before, which we know that a year before, more or less, the planet was in a lockdown, right? So, I mean, you cannot not have better data, in essence. I mean, the bar on a year-to-year basis at the current juncture in time that we sit is so low, so ridiculously low, that everything is going to seem good. That's point number one. Point number two, sure, when you throw unmeasurable amounts of money to the economy to stimulate artificial growth, you're going to get some artificial growth. There's no denying that. So far this year, and by this year I mean in 2021, the Fed has already absorbed 84% of all the bond issuance of the US government. So in essence, we're talking about 84% debt monetization type of growth environment, right? And there is more coming to it. Definitely more coming to it. I mean, we've all heard the discussions about an infrastructure plan. Who's going to pay for that? The Federal Reserve, once again, right? So as long as they keep throwing trillions and trillions to the economy, there is going to be an artificial boom in the economy. And I say artificial because I've said it before. When you need X amount of debt to generate a fraction of that in growth, is that real growth? Of course it isn't, because that's unsustainable in the long term. But in the short term, you will definitely stimulate the numbers. You know what I mean?
Yeah. So so we'll see if the Fed chairman is willing to acknowledge.
And by the way, coming to what you said, Powell knows that. So Powell knows that this is not real growth. If the Fed steps off the gas, what do you think is going to happen with numbers? Within a few months, they're going to start tanking.
Yeah.
Guys, actually, hearing, sorry to interrupt, Blake.
No, sure.
Hearing Steve talk about debt monetization, you spoke about gold and silver earlier on. Do you know what 10-year anniversary we have very soon?
What's that?
You guys know there's been remember GameStop and how the Reddit people started playing on that stock, and then they tried to squeeze silver. Well, we're coming up to the 10-year anniversary of that week when silver was taken, 2011, was taken from $48 down to $34 within 5 trading days or 6. And they're all, I mean, if you read, if you go to Reddit and read a little bit, they're all ganging up now, and they want to try and make it
and have another anniversary.
Yeah, maybe. No, but you know what? At least they're learning. When they earlier this year, go on. Sorry?
Oi.
What? No, anyway,
I got stoned and bought Dogecoin on 420, and it didn't do me anything. But I just ate a big bag of Doritos. So is this the same type of thing?
Well, now they're learning. Last time they tried buying SLV, which is probably the most useless thing you can buy if you want silver to go higher. So they're now going to be targeting physical ETFs and physical coins and all that. But anyway,
speaking of which, you've seen, Stelio, that you've seen that the actual issues with supply of gold and silver persist, right?
Yeah, right. If you want to buy an ounce of a silver coin, for example, 1 ounce, one of the mainstream ones, you're not going to be paying $26. You'll be paying
just to give you an idea, even the Perth Mint that keeps keeps unallocated or allocated silver and gold 1-to-1, so whatever you own is physical. They've said that they will be having big delays in delivery because demand is so unusually high that they can't satisfy it as fast and as soon as they usually did.
So, hey, you know what? We're going to keep the rest of this conversation for when we come back with the ForexAnalytix traders at the Morning Edge, because we have to bring in Peter Bookbar. I know, and Dale's going to have to take over here. But I just want to say that you know, it's an interesting topic regarding silver and gold, and really, I think you gotta be looking at. You know, you got to be looking at this consolidation that we have, and I think that you know we're going to be due for a breakout here in silver. You know, one direction or the other. Whether Stelios is right or not, I think it's something that we've been watching this $24 to $27 range for really the last 2 months, and I think that we might be setting the stage for a move soon. So. Steve, Stelios, I want to thank you guys for your comments this morning.
Thank you, mate.
Coach, I want to pass it over to you so you can take it over for to bring in Peter. But I want to thank everybody for listening, and don't forget to visit our video sponsors, our ForexAnalytix Face webinar sponsors, Pepperstone Securities. If you want to learn how to get ForexAnalytix for free for a few months, open a Pepperstone account. They're one of the largest FX brokers in the world. They're out of Australia. This is myself and Chris Weston, the head of research there. Matter of fact, we're filming another analysis piece this week that'll go out to our you know, clients that are ForexAnalytix clients and Pepperstone traders. So make sure that you guys open an account with them. All right, so Dale, it's all yours.
Yep. All right. So great segue on silver, because, you know, I've been talking to Peter for years now. I'm not sure. Peter, welcome back to Face, but he's been a long-term bull on precious metals. I remember silver was 13, 14 bucks. And he said, and then even after rally, he said it had a long runway. So Peter, how are you? It's great to have you back and be able to catch up with you.
Morning. Same here. Thanks for having me.
Okay, Peter. So I just want to start off with what I believe to be your most wonderful forecast you ever made since you and I have been talking. Do you know what it is?
Inflation, maybe?
No, it was that before we really had the rollout, you were saying that the vaccine you were very hopeful about the vaccine and said that by this summer we'll be able to go hear some live music and go to a concert. So, you know, there's no one on the other side of that trade. That trade is good for everybody, and it looks like, you know, your belief and your conviction that it could happen is manifesting, that we'll be able to go out and hear some music this summer.
Well, I had no idea about the effectiveness of the vaccines, particularly, you know, when Pfizer on November 9th said that theirs is more than 90% efficacious. I just felt that going into the last 2 months of last year, we were going to get results. And even if the efficacy number was closer to 50%, which is pretty much what the flu shot was, I felt that was a good sign that people were still going to get vaccinated. While it's certainly not the same level of protection, it was going to be enough to turn the corner. So when you looked at last year, September, October, where a lot of the out-of-home stocks were trading, whether it's leisure and hospitality or cyclicals, a variety of other stocks that got hammered last year, there was, from a risk-reward standpoint going into there, I felt like an opportunity, and but certainly had no idea that the vaccines would be this effective.
Okay. Well, anyway, it was, you know, maybe it was a hope, but, you know, hope is the oxygen in our lives and the carbon monoxide in our trading. So, you know, I want to talk to you about some of the things that have happened since you and I got back together. You know, of course, we passed the last rescue package of $3 trillion. What is your belief as far as the infrastructure bill that President Biden is proposing? Do you think that they're going to be able to get something done there?
They'll get something done, but I don't think it'll be certainly as large as they first threw out. I mean,
Okay.
I think that the revenue raisers that they've talked about,
Right.
particularly on the capital gain side, is so extreme that you wonder if someone within the White House can call themselves an economist by even throwing out that number.
Yeah, like a trial balloon, and the market see how the market would react to that, and people would
Well, it's hard
react.
to believe that even an economist would throw out that kind of trial balloon, because there's no economic rationale for even something that is that high. Because once you get above a certain level of on the capital gains tax rate, you actually do damage, because you never take in the revenue that you think, and you do you drag on the economy as well. So it's double negative, and I don't know who would have thrown that out there and called themselves an economist at the same time.
Yeah, isn't it a bit contradictory to the rhetoric about, we need to give this economy as much help as possible, and then raising taxes could be, putting the brakes on anything that happens? I mean, raising taxes is not, bullish for economic activity, is it?
No, not at all.
Yeah.
But we know that policy is not necessarily being made on strictly economic foundations.
Yeah.
So, but you talk about infrastructure, and we talk about it in a very simplistic way. And for your listeners that have traveled overseas, you probably noticed that, at least relative to many airports in the U.S., particularly those in the Northeast, airports outside the country are much nicer. And that is not because they spend more. That is because a lot of these airports overseas have been privatized, where you can actually buy stock in a lot of publicly traded airports outside of the U.S. You can buy stock in a lot of highways, toll roads outside of the U.S. Now, there's some in the U.S. that are privatized, but there's this belief that we don't spend enough, but there's also a belief that we spend plenty. It's just not being efficiently spent. I mean, everybody who goes over a bridge, at least that lives in the Northeast in New York, knows that New York City is taking in an enormous amount of money in tolls. And then you just have to ask, well, where's all that money going? So it's not like there's not a flow of money and ways of paying for these things.
It's government versus private ownership. That's the difference.
Yeah. Yes, for sure.
Okay.
Peter, good morning. Same thing happened to Greece. We have a lot of airports because we have a lot of islands. Many of them were at a tragic situation. I mean, public and all. We sold 30 of them to Fraport, which is like a German company. And guess what? They're now making money, and they've now become beautiful airports from like abandoned. I don't want to use bad words, but if I have to describe them, I will be forced to. If public spending actually created wealth, then all countries would be wealthy.
Right, and you give the good example of Fraport as an airport that you can buy. You can buy a piece of Heathrow. You can buy a piece of the Paris airport, Charles de Gaulle. You can buy even the Beijing and the Shanghai airports. So ironic that you can buy stock in a Chinese airport, but you can't buy stock in JFK Airport.
Well, great idea, but probably a very big long shot, considering we have a Democratic administration that believes government is, the solution to almost every problem. It'd be interesting and probably a great sign if Biden would break with that and do some private-public partnerships. We'll see. It's only been 100 days.
Yeah, well, another problem is actually finding. So let's just say you decide on a project. The amount of time that it takes to, first of all, decide on a project, design the project, get permitting for the project,
years.
And then actually hire people to do the project. I mean, right now we have major supply side issues with labor. We have help wanted signs everywhere. We have almost 7.5 million job openings in the U.S., which is near record high. And you have employers that can't find employees. Now,
Why
part
is
of
that? That
is-
people just do not, all the people that lost jobs, they probably don't have the skills for a lot of these jobs, but could it also be that, once you put people on the dole, that they're not as motivated to go out and work for the same amount of money that they would make in the private sector until all these support programs are over?
That is definitely a major factor. If you think that based on regular state paid claims plus the added $300, in many places it's the equivalent on a 40-hour work week of $17 to $18 an hour.
Yeah.
So a lot of employers, particularly lower income employees like at restaurants or movie theaters or that rely more on tips, that is tough to compete against. Look at high school kids. How is someone going to hire a high school kid if they're competing against $18 an hour? Not that a high school kid is getting unemployment benefits, but it could be for the summer. It could, you get my point. So that is an issue, that this major disconnect between a high level of job openings relative to the large gap between the number of people that were hired in February of last year versus now. Plus, you make the good point about skills mismatch. Also, I'm sure that there are issues with schools and not being reopened. So that probably led to one of two parents being at home.
So could this also lead to higher wages competing, and wages could be part of the inflation mode that we're moving into, higher wages finally translating into a stronger consumer and more demand and higher prices?
I believe so. I think in the Fed Beige Book a few weeks ago, there were quotes from different companies that were forced to raise wages. Now, it's a good thing to have higher wages, that's for sure, but it's better to have higher wages based on higher productivity, rather than because you're competing against unemployment insurance, for example, or a skills mismatch. So there, I guess you can call it healthier ways of getting higher wages, because the higher wages through better productivity means that companies are able to absorb those higher wages and employees can make more money. If they're being forced to raise wages now just to get people off the sidelines, well, they're going to try to recoup that through higher prices to the consumer, with a more challenging opportunity to get that through productivity gains, which then gets into an inflationary situation that I believe that we are in the early stages of.
Okay, early stages of inflation. I wanted to ask you about, a lot of people drawing comparisons to what's happening in the market to the 2000 bubble. But the major difference, I'm wondering what you think about this, is that there isn't just a dot-com bubble going on here. You can't find an asset class that isn't some type of bubble. Real estate, equities, commodities, look at the grains, crypto. You have these NFTs that I'm not even sure what they are. And have you ever seen even some of the junk altcoins are going up 1,000%? Have you ever seen more rampant speculation across the board in so many different asset classes in your career?
Well, it's pretty rampant, as you say, but the ultimate bubble, where all the assets you just named are a byproduct of that, is in fixed income. It is in a world of negative and zero interest rates.
Okay.
And the European bond market is, to me, the biggest bubble in the history of all financial markets. Obviously driven by ECB policy. So everything else that is priced off that low cost of money, therefore, as a byproduct, are bubbles too. But of course, bubbles can last. That's why this inflation discussion is so important, because if there is one thing that can alter and pop these bubbles, or it is if inflation digs in on a more than temporary basis, and that then filters into higher global interest rates. Not that central banks are going to be pushing rates higher anytime soon on their own, but market-driven interest rates have already had a move. And look at the U.S. 10-year. We've gone from 90 basis points to even today 158. We were almost as high as 180 not too long ago. The German 10-year is the least negative in about a year. It's still negative, of course, but it's at least the least negative. That there was such a move that the ECB came out and said we are going to front load our purchases because we don't like the rise in interest rates. So the bond market is beginning to sort of get a voice. They're having their own sets of opinion on the growth and inflation story that is different than where central banks want interest rates to go. And again, that's why this transitory or not transitory discussion on inflation is so crucial.
So this was the reemergence and the resurrection of the bond vigilantes right here, Peter. This move I'm showing from 0.5 to 180. They went away for quite a long time. You think they're back, and to me, it looks like maybe the 10-year might even be able to pull back to 1%. If we get a break in rates and the lows are in, could this next break in rates, instead of being constructive for the market, be caused by some type of correction in the market where we get some type of flight to quality in the bond market? Like here's TLT. It looks like it could, rally from here a bit, that it'll be, people might be rooting for lower rates, but, if we get lower rates and the market doesn't respond, that, people might be moving into bonds because of, valuation levels in the S&Ps as they approach 4,200.
I think the risk is ever higher rates. I don't
ever higher.
I think we're carving out on the 10-year range of 1.5 to 1.75 here. And
1.5. Okay.
Yeah, and I think that once you get to sort of June, July, August, when there's no more transitory excuses on inflation, that if inflation remains sticky and moving still higher, I think that's when you get the leg in the 10-year up to 2% plus.
Yeah. Okay. Because this would measure if we had, developed some type of right shoulder here. I know, maybe, technical analysis is in your bag, but, a move from here, would take us well up above 2%. Like, what did you say? 2.5, Peter?
I think 2.5.
Okay. Right here.
2.5 on an overshoot, but certainly 2.
Okay.
And again, that will be the case if inflation doesn't recede like the Fed so hopes that it will.
What are you expecting from them this week, Peter? On the presser, last month, he always, everyone's expecting the same song where, dovish, dovish, dovish. Could there be any hints about a taper? Canada was the first country to do it. Could Powell possibly hint about it? And like you say, they're S&P dependent, not data dependent, and they have a cushion with the market being up at 4,200 that, if we came off 5-10%, it wouldn't be the end of the world. It's not 2,500, it's 4,200.
So yes, Canada announced a taper, and they also announced that they expect that their inflation target will be met sooner than their previous estimate, which implies a rate hike sooner than what they thought at their January forecast. The Bank of Japan, about a month ago, announced that they were going to tolerate a wider band around their yield curve control. There was a Bloomberg story on Friday that discussions are heating up within the European Central Bank about tapering their emergency pandemic purchase program and not waiting till March 2022 when it expires. So the pressure on the Fed to at least begin a taper is intensifying. Not that QE out to 5 or 6 years is doing anything other than psychological. The pressure is growing. I mean, you just look at where commodity prices are. Tomorrow, we're going to print an almost 12% year-over-year increase in home prices. And the inflation pressures, at least on the good side right now, and spilling over into the services side, are just, as I said, intensifying for supply chain reasons, transportation cost reasons. potentially now higher wage cost reasons, commodity price reasons. I mean, copper today is printing a 10-year high. Corn is up sharply just over the past couple of weeks. Soybeans, wheat is now above $7 a bushel.
Look at that.
And now commodities are only a small, a portion of the inflation story, but you had United Microelectronics, a big semiconductor company in Taiwan, announcing last week, according to Digitons, that they were raising prices by 40% in 2022.
Wow.
So for the Fed to just sit here and continue on with QE and with this backdrop is just totally reckless. And now I don't know if Powell is ready to be talking about this on Wednesday, or he'd rather wait for the following meeting to sort of get more evidence of where the economy and the inflation story is going as the weather warms up and more people go outside. But like I said, the pressure is only going to pick up for him, and I'm not sure how he dances around it because, like you said, and I've said that they are so market sensitive. And I just want to emphasize that, this inflation discussion, and I'm not talking about high inflation, I'm talking about higher inflation. And the reason why that makes a difference is that if we didn't live in a world of negative interest rates or zero interest rates, and we had the Fed funds rate at 2-3%, and we had a 10-year north of 3%, those kind of interest rates can absorb a rise in inflation, a modest rise in inflation. It can absorb a 2-3% type inflation rate. But with yields where they are around the world, there's no shock absorber for a move higher in inflation. We're just not set up for it. Central bank policy is not prepared for it, even though central bankers want it. So that's the difference.
Financial markets aren't set up for it either, are they?
Correct.
Okay, so that could be something that could be a little deflationary if we had a pretty good break in the market. Don't you think it could take some of these asset prices that have just gone to the moon, correct with the market? They say you could own the best stock in a bad market and it doesn't matter. So if we get that type of correction, maybe that would be a little bit of a headwind for the economy if we had, so dare I say it, 30% sell-off in equities. Wouldn't that put a damper on inflation, or would they continue? Or would they continue to run in a liquidation move in the market?
Well, it's very circular here because it would be inflation and higher rates that would cause the pullback in the stock market.
Okay, so you don't think that happens until we start heading above 2% or so, and the valuation models change?
Well, we've already seen a massive rolling rotation this year. We've seen air come out of even Bitcoin over the past week. We've seen air come out of the SPACs, air come out of a lot of the very overvalued work from home stocks of last year, like Zoom, for example, or Teladoc. So we have seen a rotation. We have seen some air coming out of these high-flying stocks. And you can see, well, some of it is because we're reopening and people are rotating, but you see a pretty sharp rise in rates in the long end. I mean, you have to understand that, we're so afraid of the Fed to raise rates. But the 10-year has essentially raised rates 3 times this year.
Right.
Somehow that's good in the eyes of the stock market. But God forbid the Fed raised rates 3 times, and it would freak out. But either way, cost of money, 10 years plus, has gone up sharply this year. And even the 5-year was about 35 basis points at the end of last year. And now we sit at 82.5 basis points. That is essentially, those are rate hikes.
Okay. In this environment, Peter, what are you advising people to do in this environment? You're still finding value in emerging markets have been under some pressure. What direction should we be considering? Looking overseas away from the U.S. because of dollar weakness?
I am still positive on emerging Asia.
Okay.
To narrow that down. Because emerging markets obviously includes everything from Asia to Brazil to South Africa to Mexico. I like emerging Asia. I think the Asian growth story over the next 10 years is hugely compelling, and those markets will well outperform U.S. markets over this time frame. I'm still bullish in
what countries? Vietnam?
Vietnam, yeah, South Korea and Singapore, not really emerging markets. They're fully developed, but very bullish on them. Taiwan,
Indonesia,
China, India, Indonesia, Thailand. That's just the whole reason. They're very compelling growth stories. And I even like Japanese stocks. Obviously, it's not an emerging market, but I think Japanese stocks are going to be a key beneficiary of that Asian growth. I think commodity stocks are still attractive, energy stocks, fertilizer stocks, precious metal stocks. And there's still value stocks out there that I find attractive. I'm just gun shy on the overvalued parts of the tech market where you have these amazing companies, but valuations that go along with it.
Do you think that it's possible, Peter, that we're declaring victory against COVID, kind of like when President Bush landed on the aircraft carrier? And it was not the end, it was the beginning of the end, not victory.
No.
With all the variants out there, do you think that there's a possibility that some of the that people that are fully vaccinated could start to contract it? That would unwind the whole reopening story if something like that happened in the fall.
It could, but I'm confident in the efficacy of these vaccines, and I think whether people are going to need a booster in the fall going into the winter or not, I think the COVID numbers are going to collapse around the world over the next month, and it's going to become something that we'll have to live with, but something that we'll be able to manage well. So the medical world, I believe, will conquer COVID, and I think we're clearly seeing the signs. I mean, in the U.S., there's still 3 million people a day are getting shots.
Yeah.
So if you look at the experience of Israel, we are basically where Israel was back in February, and their numbers started to collapse soon after. And you're going to see the same here. Europe is even getting better in rolling out the vaccine. Obviously, you have issues like with India. That's been terrible with the big flare up. But I think they will get back in control of it, and they will ramp up the vaccine rollout. And plus the summer and people being more outside, that I think that we have now control of COVID rather than the other way around.
Okay, well that's great news, and I'm certainly tired of being cooped up and starting to get out there a little bit. Peter, I've talked to a lot of people, and you brought up Europe, and a lot of the bears are very concerned about banking crisis. The Italian banks are basically broke, and there's some votes coming up in Europe. There's also the Scottish referendum. And why do you think Draghi is playing, after being, the head of the ECB, playing such a big role in what's happening in Italy right now?
Well, people perceive Draghi as the statesman that has sort of the moral authority of his people.
I'll do anything it takes.
Right, even though he was the most dangerous central banker ever to walk this earth and has just destroyed the region's bond markets, and God forbid they ever have to get out of zero interest rates. But it's just perception. And I don't think Draghi will have a political history any different than what we've seen from Italy since World War II, where we've had probably 60 to 65 different governments since then. And obviously the big test is how these countries are going to spend the 750 billion euros that are going to be sent to them via grants and loans. And obviously each country is coming up with their own plan to how to allocate capital. But it's all central planning that is going to be allocating this capital. And that will all end in the same way. And that will be Draghi's
swan song,
but not in a good way.
Yeah, he should have done what John Elway did: step away after you win the Super Bowl. So Peter, it's great talking to you. I want to just show everyone your website and how they could follow you. You can go, Peter, if you want to follow him on Twitter, it's at pbookvar. And here's your website. And ahead of the, he's prepping his people for the FOMC meeting, and there's some great content on here. And do you think we'll ever, middle class people will ever be able to buy a home again in America?
Well, it's another unfortunate thing that the Fed has done is again,
Yeah.
like we haven't seen this before, goosing home prices to
Yeah.
such an extraordinary extent, and not only that, making it even more difficult for the first-time buyer to compete against all cash buyers, pension funds, private equity, foreign investors that are now buying homes so they can rent out in their yield grab.
Right.
So
Right.
it's really a shame, and so I root for a slower pace of home price gains because we need that first-time home buyer, and we lose them with these kind of aggressive home price increases.
All right. Well, Inflation Bull, Peter Bookvar,
Thank you,
you
Dale.
very much. It was great talking to you again, Peter.
Yeah, appreciate having me on.
Yeah, I hope you have a great summer, and
Thank you. You too.
we'll talk to you, in a few months. We'll get back
Great.
together and see what's happening.
All
Peter
right, sounds
Bookvar,
good.
everybody.
Thanks so much.
That's going to be a wrap. Remember, don't just count your inflation hedges, count your blessings. Could join the team in 14 minutes for the morning edge, and we'll see everyone for Turnaround Tuesday. It's going to be a exciting week with the Fed, so keep some powder dry. And that's going to be a wrap. Thank you, everyone. See you tomorrow.